Hello friends, welcome to learning sessions, and in today's video it's related to the shared capital. Now there are two important documents with the company. There are actually different documents, but two important documents are there. One it is the MOA, that is said to be the Memorandum of Association, and the other one it is AOA, that is Articles of Association. How the company is going to deal with the outer world, that is being dealt in MOA, that is being dealt in MOA, and how the company internal rules are going to prevail, internal policies, procedures are there, that is under the AOA, that is Articles of Association. So MOA is related to that, how is the company going to deal with the outer world, and what are the internal laws, procedure, policies, etc. Those are mentioned as per the AOA, that is Articles of Association. Both the documents are public documents. What do you mean by public documents? That these are available in public domain, right? And anyone can be looking at these documents. While before dealing with the company, you are to look into these documents. It will be assumed that you have gone through these documents. It will be presumed like that. It will be presumed like that, that you have already gone through these documents, right? And there is a different, there is an important clause that is there in case of the MOA, that is a capital clause. There is a clause which is very much important. There is a capital clause. Now capital clause states a maximum amount, a maximum amount which can be, which can actually be raised by the company. Maximum amount of the capital which can be raised by the company, and that particular amount is, capital amount is said to be the authorized capital. That is a maximum amount which can be raised by the company, right? And this is said to be the nominal capital also, or registered capital also. Simply we say to be the nominal capital or the registered capital. Now let's assume the example here, that the maximum capital which can be issued by, we are taking the example of ABC company. The maximum amount of capital which can be issued by the ABC Limited is mentioned to be, let's say, 17,500 crores. The red circle is showcasing the maximum amount of the capital, that is 17,500 crores. And out of this, the company decided so as to issue 10,000 crores. The company decided that will be issuing 10,000 crores. So that is said to be the issued capital. The company decided that will be issuing 10,000 crores out of it. 10,000 crores out of it, and that will be forming the issued capital. Now for that particular purpose, the company is to issue a prospectus. The company will be issuing a prospectus, and the public will be subscribing to that particular capital, paying the application money, right? Uh, Now in today era, it's basically through the ASBA, right? But the people are to give the application for the same, so that the shares can be allotted to them. So they are going to subscribe the capital, so that they can be subscribing the capital. Now I'm going to draw two black circles. The black circles are indicating the subscribed capital. That those are indicating the subscribed capital, right? Now one circle is basically, you can clearly be looking at, it's basically covering lesser area than the issued capital, right? That's showcasing the case of the under subscription. That showcasing the case of under subscription. And one circle is covering more area than the issued capital. That's a case related to over subscription. That's the case related to over subscription. Now what does this indicate? This indicates, this indicates that, let's say the company issued the capital amounting 10,000 crores. Now when the company issued the prospectus, company received applications more than 10,000 crore rupees. The company, let's say, received the applications for 12,000 crores. Although the company can maximally be issuing 10,000 crores now, because the issued capital is 10,000 crore for now, right? But company received much more applications than that particular amount which is mentioned under the issued capital, right? So that will be the scenario related to over subscription. This particular thing, over subscription. And when the company received lesser applications, even lesser than the issued capital, that will be the scenario of the under subscription, right? Now after that, the shares will be allotted. shares will be allotted, and there can be different cases. Let's say if the case related to the over subscription is there. Let's say first of all related to under subscription. The case related to under subscription is there. Now when the case related to under subscription is there, out of 10,000 crores, people applied only for, let's say, 9,200 crores of the shares. The company will be issuing shares to amounting 9,200 crore rupees. That's quite simple. No issues in that, because company basically wanted to issue the shares amounting 10,000 crores, but company was not able to do so. People applied for 9,200 crore rupees of shares, and the company issued simply 9,200 crores of shares. That's a simple case. But when we're talking about the case of the over subscription, when we are talking about the case of the over subscription, in that scenario, the company wanted to issue 10,000 crores of shares, but the people applied for 12,000 crores of shares. But there is a restriction that company can be issuing for the company can be issuing for the issued capital only, maximally, not more than that. It's not the case that the company received the applications for more than the issued capital, and further the companies to issue money for the same companies to issue those much extra amount of shares. Not allowed. That is not allowed, right? So now what is to be done? Now what is to be done? So it will be the case that the company will either be issuing proportionately lower amount of shares to each and every allotter, every application. For every application, the company will be allotting the shares. The first case could be there, like to all. Or it could be the case that the company will be issuing shares in full to, let's say, 90% shareholders, to all the shares which they have applied for have been issued, and 10% have not been issued the shares at all, right? Or it could be the case that the company have issued shares to some of them in full, and to some of them in partial number of shares, right? So there can be different scenarios for the case where the oversubscription is there. Why I am telling you? Because under accounting it is very much required. When we'll be solving the journal entries for these now, when we'll be looking into the journal entries, then we'll be understanding, right? So when the shares now are allotted, let's say the company has decided the criteria that how we are going to allot the shares, and the company now allotted the shares. Company now allotted the shares. Now when the company will be allotting the shares, when the company will be allotting the shares, right? Then the subscribers are to pay the amount. Let's say person A applied for the shares, 100 shares, and he was issued 100 shares. Now they are going to pay the money. They are going to pay the money. So it can be under the different calls. The money paid will be under the different calls, can be under the different calls, like application money will be paid along with the application. And after that, let's say first call was, let's say the share price is 100 rupees, right? The company asked for the application money of rupees 10 per share. And when the shares were allotted, the company called for a first call, let's say for rupees 20, right? So that will be the first call. And the amount which will be actually be paid to the company, let's say the person A paid 5,000 rupees. The person A paid 5,000 rupees application money, and further for the first call he paid, let's say, 2,000 rupees. For the first call he paid rupees 2,000 rupees. Now this 7,000 rupees is going to form the paid up capital. So paid up capital is actually the actual amount which is paid by the subscriber, paid by the subscriber or the allottee to the company, right? Which is actually received by the company. That is the paid up capital of the company, right? So authorized capital is just the amount which is mentioned under the documents of the company. Issued capital is the maximum amount that the company is going to issue for this time, for which the company is going to roll out the IPO. And the applications which are received, that is basically the subscribed capital. And the amount which is called up, or basically being called up, that is the called up capital. And the amount which is actually being received by the company, that is the paid up capital. That is said to be the paid up capital, right? Clear so far? Now, we are going to learn about the other topic, that's the share capital of a company limited by shares. Now, share capital of the company limited by shares, it can either be equity share capital or the preference share capital. Now equity capital, we can simply be saying it's a general capital which is available. So equity capital gives you right to vote. It gives you the voting rights that you can vote, right? And further, you can also be receiving the dividend. You can also be receiving the dividend based subject to the availability of the profits, subject to the declaration of the dividends, right? So those are the benefits which are available to the equity share capital holder, right? And when we're talking about the preference shares give you a preference, give you preference when the dividends are being paid. Let's say when the dividend is declared, right, and person A is holding the preference shares, the person A will be receiving the dividend in basically he will be having a preference. He'll be having a preference that he is going to receive the dividend, right? And also when the company is liquidated, in that scenario, the preference so as to pay off the liabilities of the preference shareholders is more prior, right? When the amount is being paid off by the liquidator, then first of all, the amount which is being paid by the preference shareholders will be paid off first. And after that, if some amount is remaining, then it will be paid off to the equity shareholders, right? So that is the scenario. And there are different type of the preference shares. Like we are having the cumulative preference shares, redeemable preference shares, participating preference shares, right? There are different preference shares. But there is one thing, like now you're getting the preference, but the voting rights would be limited or no voting rights would be there. Voting rights are either limited or no voting rights are there in case of the preference shares here, right? So first topic that we are going to cover related to preference shares, it is the cumulative preference shares. Now, what do you mean by cumulation? Cumulation means, let's say the dividend for the year 2023 was not declared, 2024 is not declared, but in 2025 the dividend is declared. Now, if it is a cumulative preference shares, now the dividend will be accumulated and it will be paid as an arrear in a year 2025. It will be paid as an arrear in the year 2025 when it was not declared in the previous years. And if it is non-cumulative, in that scenario, there will be no accumulation. There will be no accumulation. And if it is non-cumulative, then only for the year 2025, the dividend will be paid and not for the previous years when the dividend was not paid. And further, it is related to redeemable preference shares. Redeemable preference shares are basically those preference shares which can be redeemed, and further the amount can be paid back to the shareholder after a fixed tenure, after a fixed period. The shares can be paid back, but the company limited by the shares, and also if it is permitted by its article, they can be issuing the preference shares. And further, the redemption of the shares can only be done, the redemption of the shares can only be done maximum within the period of 20 years and not more than that from the date of issue, right? And further, it's related to participating preferences. Participating preferences, like in case of the participating preferences, participating preference shareholders can be participating under the profits of the company. Let's say the dividends are declared, the retained earnings are being retained, and after that, if there is any profit, the participating preference shares would be able to participate under the that particular extra profit amount which is not used anywhere, right? So the appropriation can be made to them also in that scenario, and also they can be exercising the voting rights. Otherwise, in general scenario, the voting rights are very much limited or not available to the preference shareholders. Okay. Then it is related to the bonus shares. I already explained the concept to you related to bonus shares. So it's like just a free share which will be issued by the company, and there is no change in the net worth when the bonus shares are being issued. And it is just the capitalization of the reserves and profit. It is just the capitalization of the reserves and profit that, from the accounting point of view, if want to understand, it is just like debiting the balance from one account and to credit the balance in other account, and both the account of yours, right? Simply as that you are maintaining two accounts, and we are just going to debit the balance from one account and want to credit the balance in another account, nothing else, and nothing else. That is basically the bonus shares are, right? And further, it is a conversion of the reserves and surplus only. It is a conversion of the reserves and surplus only into the shared capital. Now, shared capital is basically the paid up share capital. Either we say it to be the shareholder equity fund, or we say it to be the paid up share capital, one and same thing. One and same thing, right? And it can only be issued if basically articles of association does allow, that is AOA allowing you, then you can be issuing the bonus shares. Then the bonus shares can be issued, otherwise not. Otherwise, you won't be able to issue the bonus shares. Right with it? And further after that, it's related to the non-voting shares. It's about the non-voting shares. Now, non-voting means what? See, whenever the company is going to issue the shares, let's say company ABC is here and company is going to share the shares. Now, when the company is issuing the shares, company is giving away their control also. Company is receiving the capital, right? But the company is giving away the control, right? The main object is related to that you want to get the capital, but you don't want to give away the control, right? So the main funda related to non-equity share, non-voting shares is there, related to that we want to generate the resources, we want to raise the capital, but we don't want to lose the management control. We don't want to lose the management control, but there are some restrictions or conditions related to the non-equity shares, right? First of all, it should be authorized by the articles of associations and should be approved by the shareholders under the annual general meeting, right? Only then it can be issued. Only then you can be issuing the non-voting shares. And further, special resolution is to be passed. Special resolution is to be passed, and shareholders who are basically non-voting shares, right? Basically, they're eligible for all the other, they are eligible for all the other benefits. Like if the bonus shares are to be given, those will be given to the non-voting shares also. And also the if there is any bonus shares are being given, that is basically they will be giving out, they will be getting the bonus shares. And also if the right issue is given, then they will be also be getting the right to basically purchase the new shares, right? Other than that, voting rights, all the rights will be available to the non-voting equity shares, right? And only 25% of the paid up capital of the company can be issued. Let's say the total paid up capital is 1000 crores. Is 1000 crores. The company is restricted that the maximum 25% means 250 crores amount of non-voting shares can be issued. Non-voting shares can be issued and not more than that, right? So it is written over here also that only 25% of the paid up share capital of the shares can be issued. Okay. And only a public company which is limited by shares can be issuing the non-voting shares. Not other company can be issuing the same. And no company is basically permitted that they cannot be converting their voting shares into non-voting shares. It cannot be done. It cannot be done. Is that clear? Now, it's about the issue of the shares. Very important. It's about the issue of the shares. Now, issue of the shares means what? From the prospective borrower is going to, when the prospective borrower is going to apply for the shares in the prescribed format, we say the application is received. Now, like I told you, that's basically forming the subscribed capital. Now, the subscribed capital is basically of two forms. Either it can be the case of oversubscription or it is a case of undersubscription. When the more applications are received, we say it to be the oversubscription. And when the lesser applications are received, we say it to be the undersubscription, right? And also, it is very much required that when we are having the under subscription, then you're going to issue the shares to all, right? But when it is a case of over subscription, then the board of directors are to decide that which shareholders are to be accepted and in what proportion it is to be accepted. So that will be forming the basis of allotment. That is going to form the basis of allotment, right? So it could be the case that you have rejected the some of the applications. It could be the case that you have rejected some of the applications, those are to be rejected, and particular amount which is received as application amount, that is to be refunded back. That is to be refunded back. And it could be the case that you have accepted the application on pro rata basis. On pro rata basis. Let's say person A applied for 100 shares and you decided that you will be allotting 80% of the shares. You'll be allotting 80% of the shares. So person A applied for 100 shares, he will be allotted 80% and money will be refunded for 20% of the shares or 20 shares here, right? So in that scenario, if the application is accepted on pro rata basis, the excess amount which is received, that is going to be refunded, or we can be adjusting it toward the future dues of the shares. If the amount in full is not received beforehand, in that scenario, we can be adjusting the amount further. For the further balances, whatsoever the amount was to be received, we can be adjusting it. Let's take the case that the total number of shares which are issued, which was basically applied for, were 100. The person applied for 100 shares and further he paid an application money of, let's say, rupees 10,000, and you decided that 80 shares are to be issued and 20 shares are not to be issued, right? Now this 10,000 amount which was paid as application money for 100 shares can be adjusted toward the total payment of the 80 shares. Like the total payment was made to be rupees rupees 20,000. Let's say for the 80 shares, the total amount was to be paid rupees 20,000, and now you have already received 10,000 rupees. You can be adjusting toward it, right? No refund will be marked. So that can be done. Okay. So this is to be done. So if the subscription money is proposed to be received in cash, the calls shall be structured in such a manner that the entire subscription money is called within the 12 months from the date of allotment. That the complete, if the subscription money is proposed to be received in cash, right, the calls shall be structured in such a manner. Call means what? That we are calling the money for. Like the person applied for 100 shares, 100 shares, each share is amounting, let's say, rupees 200. The total amount is rupees 20,000. It is total amount rupees 20,000. The person paid 8,000 as the application money and left to pay with 12,000 rupees. The company called that you are to pay rupees 4,000 first of all. That was the first call, and second call, and so on. So it is just said that if you are to want to get to receive the money in cash, then we are to structure our calls in such a manner that the complete amount is received in 12 months. And if the issue size is above rupees 500 crores, if it is 500 crores, more than 500 crores, right, then it is not required that you are to basically uh, call the entire call money within 12 months. Then this clause won't be available if the issue size is more above 500 crores, if it is more than 500 crores. Clear with it? Issue of shares at discount. Issuing of the shares at discount. That's about the section 53 of the Companies Act. So general rule says that a company cannot be issuing the shares at a discount. And any shares which are issued at a discount will be said to be void. It will be said to be void. But there are some conditions related to it. There is some exception related to it. And the exception is the sweat equity. Exception is what? Exception is the sweat equity. So if you're going to issue the shares for the sweat equity purposes, which is governed by the section 54, that is allowed. That is allowed. Otherwise, issuing the shares at discount is not allowed. And further, if you any of the company violates the section 53, it comes under section 53. And any of the company violates section 53, in that scenario, penalty can be there, which may be up to the amount raised by the at the discount purposes, or rupees 5 lakh, whichever is lower, right? So the penalty can be up to of rupees 5 lakh, not lesser than rupees 1 lakh, but up to rupees 5 lakh, right? And further, every single officer who is basically in default shall be punishable with imprisonment of a term which may extend up to 6 months, and further fine which not will be less than 1 lakh rupees and which may be extended to rupees 5 lakh rupees. So penalty on the company and every single officer who will be involved in that, who will be involved in that. Now, next one it's related to, now we should be learning about the sweat equity shares. It's about the sweat equity. Now, what do you mean by sweat equity? Now, if the company is going to issue the shares to the employees, right, who are basically the employees, or let's say the directors of the company, let's say for the purpose, for their know-how, for intellectual property rights, for value addition, for professional expertise or technical expertise, that will be what? That will be the sweat equity. So sweat equity shares are the equity shares. First of all, these are the equity shares normally, but those will be issued at discount. Those will be issued at discount, or those can be issued for the purpose of their consideration rather than cash. So let's say company XYZ is paying remuneration to the director, but not in cash, in form of shares. In form of shares, right? That will be what? That will be sweat equity. So permanent employees of the company can be receiving it, directors can be receiving it, right? And employees or directors of the holding company or subsidiary companies can be receiving it. That is the case. And this issue is basically authorized by a special resolution. There should be a special resolution which will be passed by the company. And the resolution will be specifying that what number of shares will be issued, what is the current market price, consideration, or let's say what amount is to be issued at, right? And further, from the date of the issue, from the date of the issue, at the date of the such issue, not less than 1 year, right, should have elapsed. So minimum 1 year should have elapsed that the company had commenced its business. Only after that the sweat equity can be issued, right? And when the equity shares are listed on the stock exchange, sweat equity shares can be issued, but as per the regulations of the SEBI only. So the SEBI regulations are to be followed in the scenario, when the company is to issue the sweat equity and the company is listed on the recognized stock exchange, right? Further after that, it's related to the ESOS, that is Employee Stock Option Scheme. ESOS is Employee Stock Option Complete Scheme. So company is going to grant options to their employees or directors that they can be purchasing the company shares at a predetermined price. So ESOS is something related that it's allowing a option to the directors, to the employees, that you can be purchasing the shares at a predetermined price. At a predetermined price. That's what, that is the ESOS. That is related to the ESOS. And for the ESOS scheme comes under the company grants option. It comes under the company grants options. And SEBI has issued the guidelines for the ESOS for the listed companies. So the permanent employees are eligible, directors are eligible, and like I told you, the persons who were eligible for the sweat equity, they are eligible here in this scenario also. But promoters are not eligible for ESOS. Promoters are not eligible, and directors who are holding more than 10% of the equity, those are also not eligible. Those are also not eligible, right? And minimum 1 year must have elapsed before commencing of the business by the company, before giving the option related to the ESOS. And definitely the special resolution is mandatory in case of the general meeting, right? That is actually required. And the company is to maintain a ESOP registered. ESOP register is also to be maintained. Further after that, it's related to the forfeiture and reissue of the shares. It's about the forfeiture. Now, forfeiture means what? Forfeiture means cancellation of the shares allotted. Let's say the company issued the shares, but the dues were not paid in time, right? In that scenario, the cancellation of shares is to be done. So, forfeiture of the share means that we are to cancel the allotment of the shares. That we are to cancel the allotment of the shares due to the non-payment of the calls. Let's say what's of the allotment money or call money that was not paid by the shareholder, and that is to be cancelled, right? And the legal basis for the forfeiture is provided under the AOA, because I told you very much clearly the AOA is about the internal rules and regulations. Internal rules and regulations, right? So that's the scenario. So when the shareholder does not pay dues on shares which he or she holds, the company is going to send a reminder. The company can be sending a notice basically that you have to pay this amount. And if they do continue this default, company is going to send them a final notice. And this final notice, right, is to be that they are to pay the dues within a period of 14 days. And if they have not paid the dues in the next 14 days when the final notice is served, the board can be passing a resolution. In that scenario, the board can pass a resolution so as to forfeit the shares. And forfeiture means what? That the name, the shares are cancelled and the name of the defaulting shareholders is to be deleted from the from the register of members. So there is a register of members which is maintained electronically, also it can be maintained, and the shareholder name is to be deleted from that particular register, right? And let's say even if he or she has paid a advance amount or application money amount, that is also to be forfeited. That amount is also to be forfeited and won't be refunded back. So in that scenario, what would be it? It will be the share capital account. Let's say you have received the application and you debited the application account and further you credited it to the share capital account. That's a paid up equity capital, right? Now you have to debit that particular share equity account or the share capital account. Why? Because you forfeited the shares. Let's say case we received 1200 rupees. We received 1200 rupees. Now we'll be debiting rupees 1200. The application money which we received, right? 1200 will be debiting. And further, that is to be credited to the calls in arrear account. To calls in arrear account, right? That is to be credited, and forfeited share account should be credited also. But the point is that even though the shares are forfeited, those are cancelled. These forfeited shares can still be reissued by the company at any time. The company can be reissuing these shares, right? But let's say the amount in arrear which was pending, let's say the shares were issued for rupees 10,000 and you received rupees 1200. You received rupees 1200 and the total worth of the share was rupees 10,000. So you can be reissuing these shares, forfeited shares, but the balance amount, that the arrear amount was rupees 8800. You cannot be issuing the shares below this arrears amount. That is to be taken care of. And let's take the case that if the total amount received on reissue forfeited shares, the total amount received on the reissue of the forfeited shares, that when we issue to some new shareholder and they basically paid the amount, right, that is exceeding the face value of the share, then whatsoever the excess amount is there, that will be transferred to the capital reserve account, right? Let's take the case the previous forfeited amount was rupees 1200, right? And the new shareholder paid 10,000 again. Now the face value was 100 shares were issued. 100 was the face value. Face value was 10,000. Excess 1200 rupees is basically received because 1200 rupees was received from the previous shareholder, and the new shareholder is from the new shareholder we received rupees 10,000 here. So the total amount exceeded the face value of the shares. Now this 1200 rupees is to be transferred to the capital reserve account. It is to be correct. It will be transferred to the credit to the capital reserve account, right? So the entry would be that the new amount is received, cash or bank account is to be debited. The share forfeited account which was previously credited will be debited and it will be transferred to the paid up capital account or the shared capital account, right? So that's all about the chapter number 14 and 15 of the module B. I hope that you must have understood the concepts related to it so far. So please do confirm that you have understood the concept so far in this chapter so that we can proceed with the next chapter from the module B. That's the chapter number 16. That's about the cash flow and the fund flow statements.